Hello, everybody. We're just going to give everyone a couple minutes to join, and then we will get started. All right, let's kick it off. Welcome, everyone. Thank you so much for joining us today. To start, unfortunately, our head of asset management, Boyd Corkins, was unable to join us this morning. However, we have Gretchen Montag stepping in for him. She is a senior member of our asset management team and has a phenomenal knowledge of and understanding into our California acquisition strategy, as well as our management of our California properties. So we're thrilled that she's able to be here today. I'm also joined by Chris Loomis, a senior associate on our client services and business development team. Chris owns numerous of our investment products, and today he'll be speaking to the water supply across our Farm Together Sustainable Farmland Fund, as well as our live crowdfunding offering, Great Valley Citrus Grove. For those who don't know me, my name is Sarah Wensley. I lead growth and marketing here at Farm Together, and I've been with the firm a little under 4.5 years. For those who might be new to us, Farm Together is an investment firm that provides investors with creative capital solutions in farmland and real assets. Our portfolio is comprised of both permanent cropland and row cropland across the US, but we specialize in high-value permanent crops, which is a highly complex and dynamic market that requires specialized expertise and quite a significant amount of experience to drive a potential long-term return for investors. To date, Farm Together manages over 48 properties across 8 states, 14 crop types, and 5 different investment products, many of which may be able to facilitate a 1031 exchange. Since joining, I have had the pleasure of basically witnessing Farm Together grow exponentially. And it has been quite a joy and a pleasure to be a part of this firm as we, increase the accessibility of farmland to a multitude of different types of investors. And with that, I am going to just give everybody a moment to read our disclaimers, and then I will pass it off to Gretchen Montag, who will lead a discussion into why California is such an agricultural powerhouse, how our firm analyzes and looks at farmland supply for properties that we're looking to potentially acquire, as well as how we sustainably manage those properties, specifically as it pertains to water. So I will just leave this up for 10 seconds, and then I will pass it off to Gretchen. Let's get started.
Thanks, Sarah, for the introduction. I'll just get right into it. With all of the headwinds producers are facing in California, including shifting water politics and ongoing supply chain disruptions, there's no doubt that farming in the state has become much more challenging. However, there are many reasons why this industry persists and should not be overlooked when thinking about an investment portfolio in ag properties. Next slide, please. Over the last decade, California has produced between 60 and 75% of the nation's fruit and nuts, and if it were its own country, would be the 5th largest overall economy in the world that is responsible for the production of over 400 different commodities. When you think of total acres in production compared to Iowa, which is the number 2 ag producing state, California is growing far beyond the staple products like corn, wheat, and soybeans. We're capable of producing specialty crops like that of the stats highlighted in this slide. 85% of global almond production, 60% of US citrus production, the majority of that going to fresh market as opposed to production for fruit juice. 93% of U.S. wine grape production, vastly outperforming even Oregon and Washington, and nearly 100% of U.S. apricot, dates, figs, kiwis, nectarines, olives, and prunes. The production of these specialty commodities can be attributed to the diverse Mediterranean climate that's very unique to this part of the world. Because of the value of these specialty crops, there's been an influx of innovative ag techniques in precision agriculture, drip irrigation and application monitoring, and advancements made in integrated pest management, with continued research and development by state educational systems, private industry, as well as government agencies. The need to adapt to increased cost and limited resources has also made California ag a leader in sustainability, highlighting topics like water conservation, greenhouse gas emission reduction, and soil health promotion, among many other improvements. Next slide, please. It's no surprise that the majority of our holdings are located in the Central Valley of California, as 85% of the state's production occurs on close to 9 million acres of farmland here. Of the 18 properties we manage in California, 14 of them are located in the Central Valley and span from as far north as Acampo to as far south as Wasco, which is just over a 230-mile stretch of territory. This portfolio includes wine grapes, almonds, pistachios, and various types of citrus fruit. Geographically, the Central Valley runs from the north, bordering the Sacramento River Delta area, to the southern border of the Tehachapi Mountains, and is in the middle of the state, bordered by the Sierra Nevada Mountains to the east and the coastal ranges to the west. Within this growing region, there's also a very large network of farmers and growers who are responsible for a diversified number of crops, processors and packers of the products that we work with directly to ensure the sale of our products, wholesalers and distributors of those products, namely with those with access to export markets, which is imperative for our tree nut properties, and support services in research and development, logistics, as well as financial and legal services. And anyone that's visited in the summer knows how hot and dry the conditions can be. But this, along with mild, wet winters, makes it an ideal growing region for many crops. Next slide. To drive home the point of how special this growing region is, please take a look at the map to understand that we are part of 5 regions in the entire world and the only one in the United States with this level of advantage in crop production. The climate in California can only be found in around 3% of the world's total land mass. Because of the countless microclimates, there's major variability in rainfall by region, and about 3/4 of the rainfall is north of Sacramento, which is just north of the geographical borders of the Central Valley. Because of this variability and the feast or famine nature of rainfall in this Mediterranean climate, California has a rich history in water storage and conveyance for agricultural, environmental, and residential use throughout the state. Next slide. For growers in the Central Valley, there are in general 3 tools in their tool belt for achieving an annual water budget based on crop. That would be precipitation, surface water, and groundwater. And in the Central Valley, most of the crop's water needs are in the summer, when the region is most hot and dry. And for deciduous trees, or trees that lose their leaves and go dormant in the winter, like tree nuts and wine grapes, precipitation levels throughout the winter and early spring will typically indicate when a first irrigation will occur, and varies between March and May, depending on your location within the region, as well as site-specific rainfall. But watering during the growing season is typically accomplished through either surface water deliveries or groundwater pumping, and as is the case for most of the farms under our portfolio, a blend of both. Next slide. According to real-time data reported by the California Department of Water Resources, our reservoirs are trending higher than historical averages, which typically means it will be a good year for surface water allocation. The capacity of our reservoirs is roughly 42 million acre-feet, and if you're a grower in the valley who has allocated surface water rights, it will be transferred from the reservoirs by a conveyance system that is made up of a network of canals, aqueducts, and pipelines. The Central Valley Project is an example of a federal water management system that conveys water from the Sacramento and San Joaquin rivers and their tributaries to an advanced conveyance system that distributes water captured from winter rains and snowmelt in the Sierra Nevada mountains and eventually reaches agricultural end users in the Central Valley. Once water reaches an agricultural area, typically surface water allocations are determined by irrigation districts based on available supply, demand forecasts, and regulatory requirements imposed on the district by the state. And in an average water year, 41% of the state's water demand is supplied by groundwater wells. And a grower's dependence on this groundwater increases in dry years where surface water allocations are less. Next slide. Because California growers can become dependent on groundwater wells more heavily in dry years, SGMA, or the Sustainable Groundwater Management Act, passed in 2014, aims to achieve groundwater basin sustainability by 2040. This basically means that they're providing a structured approach to ensure that the basins are managed in a way that avoids depletion and adverse impacts to water quality and our ecosystems. SGMA requires the formation of GSAs, or groundwater sustainability agencies, in high and medium priority groundwater basins across California. These agencies are then responsible for developing GSPs, which are the groundwater sustainability plans, through items like groundwater recharge projects, water recycling projects, as well as groundwater banking and inter-district water sharing initiatives. And because the most sustainable way to achieve a healthy groundwater basin would be to decrease the dependence of growers on groundwater by then increasing reliability on surface water deliveries, the Inflation Reduction Act and bipartisan infrastructure law will allocate an additional $15.4 billion to repair infrastructure and improve our drought resilience throughout the state. Next slide. So that being said, before we model any deal in California, we need to start by assessing the availability of water to the property, especially during peak growing season. This is all about determining water rights as well as physical availability of that water. In any high priority basin, this would mean verifying dual source, meaning that the property is supplied by both groundwater and surface water. So first we take a look at effective precipitation, which will most likely fall outside of peak season requirements. Looking at average rainfall can be extremely variable within regions based on crop and overall weather conditions, soil, and other factors. So the most important place to start would be to assess surface water. So is the property in an irrigation district? Have historical allocations met deliveries? And is the conveyance system within that irrigation district reliable? And what improvements have been made year over year? As well as the condition of any ditch pumps, filter stations, and irrigation district lines that are connected to the property. Additionally, we want to look at groundwater, whether or not there's a well on site or the ability to install a well for extra assurance in low surface water allocation years, and what governing agency or GSA under SGMA is the property located in, and what has been approved in the GSP. What are the management parameters? Are they focusing on groundwater recharge, pumping allocations, or credit transfers? And generally, what is the overall pumping efficiency and condition of that well? And what does it cost to run the pump? Once you understand the per acre foot requirements for the crop and the availability of all the water resources, a water budget can be developed. And after assessment of efficiencies of that system, FarmTogether can then prioritize improvements to the irrigation infrastructure to optimize productivity and resource sustainability. That being said, California agriculture is not something that can be replaced by simply investing in other crops in other states. And that's why it's so important to manage the resources effectively from the state level all the way down to the acre. And now I'll hand it off to my colleague, Chris.
Thanks, Gretchen. So for the remainder of our presentation, I will be covering our live crowdfunded offering, Great Valley Citrus Grove, and providing an update on our open-ended fund, the Sustainable Farmland Fund. Next slide, please. So for those of you who are new to our offerings, here's a quick overview of the crowdfunded product. These are private investments in an individual farm starting at $15,000. The typical hold period for these deals is 8 to 12 years, and they target a net IRR between 6 to 13%, an average net cash yield of 2 to 9%. Each deal has its own unique return profile, dependent on its maturity, its crop type, income structure, and so on. The deals are structured as individual LLCs where the LLC owns the specific property, and investors in that deal are members of the LLC with proportional ownership based on their investment amount. Next slide, please. So as a case study, we would like to review our current live offering, Great Valley Citrus Grove. The property is 56 planted acres of diversified citrus planted to both Caracara navels and ruby red grapefruit. Just over the half of the property is mature currently, having been planted in 2019, and the remainder was planted in 2021. We expect the property to reach peak production in 2029. For this deal, we are targeting a 10.1% net IRR, 9.6% average net cash yield, and net multiple on invested capital of 2.4x, all based on a 10-year hold. The first distribution for this deal is projected in 2026. Next slide, please. This property is located in the heart of the Citrus Grove in Fresno County and features ample water resources. The property receives surface water from the Alta Irrigation District and has 2 on-site wells for pumping of groundwater. The water is delivered through a micro-drip irrigation system. As noted previously by Gretchen, water is one of the most important items we underwrite for when assessing properties in California. We are confident that this property's water resources will provide an abundant supply of water for the developing and mature trees throughout the 10-year hold period, and that this property has had sufficient water resources even in periods of severe drought. As noted on the previous slide, we have syndicated over 90% of the targeted funds for this offering and are targeting a close in July on the acquisition. As we have limited capacity remaining, we do recommend securing your spot as soon as possible in this deal in order to ensure we can accommodate your allocation. Next slide, please. Now I'm going to dive into our open-ended fund, the Sustainable Farmland Fund. So here you will see a summary of the key terms for the fund. To keep it brief, I'm just going to speak to a few points here. The fund is only open to US-based accredited investors at this time. The fund targets an annual net distribution of 4 to 6% and a net IRR of 8 to 10% based on a 10-year hold. In contrast to the crowdfunded product, the fund is an investment in a portfolio of farms rather than a single allocation, and also offers liquidity on a quarterly basis following a 2-year lockup. In terms of portfolio composition, the fund seeks to achieve diversification on both a commodity and geographic basis, as shown in the chart on the right. And I would like to add that we are currently offering a lower minimum for the fund at $50,000 for a limited time only. Next slide, please. The fund currently holds 4 properties in its portfolio, 3 of which were acquired in 2023. The portfolio is diversified across 3 states and 4 crop types. So wanted to drill into the water resources at each property in the fund's portfolio. So we acquired Stanley Pistachio Orchard through an off-market transaction in late 2021. This property holds riparian water rights for surface water from the Sacramento River and also has an on-site well for groundwater. In Q1 of this year, we completed installation of a tile drainage system at the property to help to remove seepage water from the most susceptible places on the property. And we ultimately believe this project will help control erosion as well as maintain tree health. The second acquisition, Silver Linings, was acquired in January of 2023 and features 2 sources of water similar to Great Valley Citrus Grove, having a surface water allocation from its irrigation district in addition to an on-site well. The third and fourth acquisition, Centennial Farm and Loma Pecan Orchard, were acquired in March and October of 2023, respectively. Both properties feature on-site wells and also receive sufficient annual rainfall to satisfy irrigation needs at both properties. At Loma, in the first quarter, we installed drip lines on the property for more efficient use of irrigation water as the trees continue to develop. We are actively sourcing opportunities for the fund's 5th acquisition to further build out its diversification. Next slide, please. So shifting to fund performance, 2023 was a strong year for the fund. In addition to the multiple acquisitions we made, the fund outperformed the benchmark index, the NCREIF Farmland Index, each quarter in 2023 on a gross basis. Overall, the fund returned a 10.1% gross IRR, 7.7% net in 2023, outperforming the benchmark index on a gross basis by over 500 basis points. The fund also met its income target of 4 to 6%, crossing a 4% distribution to investors for 2023. The performance of the fund in 2023 was largely driven by booked unrealized appreciation on the fund's properties. from updated third-party appraisals, in addition to rental and operating income from the properties. On a weighted average basis, the portfolio currently holds unrealized appreciation of 12.6% based on the 2023 appraisals. Stanley Pistachio Orchard specifically has recorded 18% appreciation since acquisition in 2021, which we believe is a testament to its high productivity and its strong water resources. I would like to now pass it back over to Sarah to provide a quick overview of sustainable practices across our portfolio.
Thank you so much, Chris and Gretchen. So before we head into Q&A, I just wanted to premise that we will have another webinar in the coming weeks that focuses on sustainability at Farm Together. Sustainability is core to what we do here at our firm, and it's core to our acquisition strategy as well as our management of our portfolio. 100% of our agricultural operations are certified annually in conformance with Leading Harvest, the Leading Harvest Management Standard. So in that future presentation, we will dive into key sustainability metrics across our portfolio, how we look at regenerative agriculture, how we define it as a firm, as well as regenerative techniques that are employed across our portfolio, as well as several other metrics and factors that we take into consideration when we are managing our properties. So stay tuned in the coming weeks for an email update that will announce the date of that upcoming webinar. And with that, I will hand it to Chris, who will be owning our Q&A portion. If you haven't left a question and you have one, please leave it in the Q&A chat box, and we will get to as many as we can within the next, say, 10 to 15 minutes. So thank you all so much, and let's dive into the Q&A.
Thank you, Sarah. So we will now begin our Q&A session. We've received quite a few questions already, and we'll try to answer as many questions as we can in the next 15 minutes or so. So just going to give a second for the questions to come in. So we have a first question on water here. Can agencies restrict the well water or just the surface water? Gretchen, would you like to speak to that one?
Yeah, so agencies can restrict well water, and that's basically based on the GSA's plan through SGMA. If that's part of the groundwater sustainability plan to allocate based on crop, that is possible. And then surface water is determined by, the federal and local agencies and hydrology and water rights. So it all depends on what's available versus what your actual allocation rights are.
Great, thank you. So moving on to the next question on Great Valley. So we're asking for more details on our water due diligence at Great Valley. What is the average acre foot per acre of water for grapefruit and caracara navels annually? How much has been obtained in past years? So Gretchen, would it be helpful if we could speak to the resources in a bit more detail at Great Valley? See here, we have about, the properties are received about 2.5 acre feet of water. But, we could just speak to a bit more detail on that one.
So speaking to the actual water resources on the property, or?
Yeah, in terms of the, water received, what the needs are for the trees.
So historically, the Alta Irrigation District, this property has received 100% of their water via surface water, so they get 100% of their allocation. If there is sufficient drought in the future, this property also has wells on site to supply supplemental water to the crop during peak growing season.
Great, thank you. We have a next question on the fund here. Is the total return of the fund anticipated from income or from appreciation? So the total return is the combination of both. So it's based on both the income from annual crop proceeds or lease income, as well as the appreciation and property value on the farm. So those are the two forms of returns within farmland investing. You're looking at both income and appreciation. For the income side, that is just generated on an annual basis, either from the lease itself or from the revenue from the respective crops harvested. And then on the appreciation side, we get each property appraised on an annual basis, and that appreciation is then captured once the property is sold. That's how the total return is calculated for farmland investments. Another question on the fund here: what percentage of properties in the fund have already been acquired by FarmTogether? So all 4 properties in the fund's portfolio are wholly owned and were acquired to be added to the fund's portfolio. And then next question here on 1031s. So can you cover 1031 exchange options for funds? Yes, so we have hosted some past webinars, and we will be sure to reach out to provide some more details. But at a high level here, the 2 offerings that are 1031 eligible within our offering suite are the single asset crowdfunded deals, in addition to sole ownership opportunities. So as a 1031 investor, you could use your 1031 proceeds to be an investor in one of the single asset deals, or to be the sole owner of an individual property. And we'll be sure to reach out to provide some more details on that process. Gretchen, I might ask you on this next one. So when we are conducting due diligence on a property, of course, water is the most important, of course, but could you rank the next 3 to 4 items that we look at when reviewing an opportunity?
Yeah, of course. So after we've assessed that the property will have longevity based on water supply, it's important then to look at overall health through production history. So how does the property perform, what our revenue might be, as well as an extensive title review, environmental samples to determine the health of the property and that there are no legal issues tying up title. But overall, just that the property can perform, that it's been managed properly, and what changes we can make to kind of improve upon those if there's opportunities to increase production or maybe improve our operational costs. Those are all things we look at pretty instantaneously after we review the water supply.
Awesome. Thank you, Gretchen. Question here on how the capital call process works for the fund. So in contrast to our crowdfunded offerings, so the way those deals will work is that once we put them up on the platform, we are raising the funds for the acquisition. We typically have about a 3-month window of an escrow period to raise the funds for such an acquisition. In contrast, the Sustainable Farmland Fund raises new capital on a quarterly basis via capital calls. So at the end of each quarter, so it's a subscription request can be put in on our website at any time. But in terms of funding the investment itself, we would issue a capital call at the end of each quarter, or as needed for an acquisition. For example, if you submitted a subscription request today, you would now be part of the 3rd quarter capital call, as we've already made the 2nd quarter capital call. So we'd be looking more at a funding timeline of towards the end of Q3. There is an onboarding process, so we will reach out if you are interested and submit a subscription request to walk through the onboarding process and explain the funding timeline in more detail. Following the initial subscription, I would like to add that you can make additional commitments on a quarterly basis in increments of 25,000. Let's see here. Next question on how do you mitigate risks associated with ag investments, such as weather-related risks like the floods in the Central Valley or other market fluctuations? So for properties that are located within flood risk regions, we do invest in flood reduction infrastructure, such as tile drainage, to mitigate the risk of sitting water damaging the trees. Crop yield related risks as a result of natural events are also mitigated through crop insurance. We take out multi-peril crop insurance at each of our mature properties, which can cover a certain percentage of a impacted yield of the property. Gretchen, do you have anything else you'd want to add on that?
No, I think that's pretty extensive. Yeah, we're just managing year to year because our amount of precipitation changes every year. So just kind of managing what areas are susceptible to high water tables and finding ways to remove that water from the root zone. has been the biggest way we've mitigated risk in recent years.
Great, thank you. So a question here on the yield assumptions at Great Valley Citrus Grove. So the seller will be retaining the 2024 crop. For 2025, we underwrote the 2019 navels at 30 bins per acre, the grapefruit at 30 bins per acre, and the 2021 navels at 20 bins per acre. As I mentioned earlier, we expect this property to reach peak production in 2029 and produce at that level for the duration of the hold. And our mature yield assumptions at the property are as follows. So we have the 2019 navels at 50 bins per acre, grapefruit at 75 bins per acre, and the 2021 navels at 50 bins per acre. And as a reminder, the first distribution for this deal is targeted in the fourth quarter of 2026. Another question on Great Valley regarding disease risk. So any diseases that impact the mandarin trees, what is this should be citrus trees. What is the disease risk? Can the trees be susceptible like the Florida citrus market? So there is lower disease risk in California compared to Florida. Some of the main differences being that California and other, California has a more rigorous spray application process and monitoring programs for these pests and diseases in comparison to other states. Gretchen, if there's anything additional you'd like to add there.
Yeah, thanks, Chris. So the Asian citrus psyllid is something that we monitor very heavily here in California because they vector the citrus greening disease. Because we've witnessed the Florida industry and their struggles with that greening disease and that pest. California has been very rigorously monitoring that for many years. And it doesn't seem to be an industry-wide presence here.
Great, thank you. A few more questions coming in here. One question here. So question if you're investing in farmland, through one of our products, are you just getting an ownership percentage, or can you physically go out and visit the person, visit the property and see the land? So that is an option. Of course, it is subject to both our farm management team's availability as well as liability from the operator perspective. So if you do end up investing in a deal, we are happy to accommodate that. It will just take some coordination between teams to make sure it can be accompanied appropriately. Let's see. Question here on the process that we have in modeling commodity pricing. So while commodity pricing is ultimately dependent on the quality of the crop, we use both historic pricing reviewed on the property, pricing received on other properties in our portfolio for that certain variety, and we also review market data for the area. So we will begin with a price that is below that historic average, and then we'll apply a 3% inflator on an annual basis throughout the whole period. Yes, another question here on water. So do water districts monitor well usage? Do they track how many acre feet a farm is extracting from the aquifer? So yes, most districts do have this in place or plan on rolling this out. We have been enrolling our California properties irrigation systems with Ag Monitor to enhance the ability to track water measurement in real time, to allow us to better manage costs and increase reporting capabilities. Gretchen, is there anything additional you might want to add on how monitoring of water usage works out?
Yeah, of course. So to Chris's point, we are getting ahead of most of the GSA's monitoring requirements by improving our telemetry on the properties, the flow meters that we have, working with companies that kind of measure kilowatt hours and water applied in real time. GSAs do, however, depending on the GSA, they'll require a well identification as well as an installation of a flow meter if you don't already have them. But most GSAs currently are using some sort of remote sensing with satellite imagery to just kind of anticipate the water usage via groundwater on a lot of these properties. But I think that's something that's going to continue to advance in the future.
Thank you. So a few more questions here. We are starting to approach time. Another question here, more of a broad, about our investment approach in general. So does Farm Together typically lease its farms or directly manage them? Why is there a preference towards one or the other? Also, if we have more of a crop focus one way or the other. I'd say we feature quite a few different ways that we structure the income on our deals. So we have what's called direct operating. So that is where the LLC owner of the property, investors in the deal, they would receive the proceeds from the harvest in terms of their distribution. There's also where we do just a simple cash lease that's typically more common amongst our row crop farms. So the corn and soybeans, those are just a very simple cash lease. Then there is more of a hybrid option where that is found on more of our pecan and hazelnut properties, where we have a base rent tied to the value of the property, the appraised value of the farm, in addition to a crop share. And the reason we lean towards these various structures on different crops, I'd say that with permanent crops such as tree nuts, tree fruit, citrus, wine grapes, most of those deals have been direct operated. And the reason we do that is because we believe that there is more upside within more of these specialty crops as compared to the leases that we put in place on our row crop farms, where there is those are lower margin. There's more subsidies in place for those type of crops. So we do decide to implement the direct operating model where we believe there is a higher possibility of upside in terms of the annual returns. And in terms of our focus, it is going to be dependent on the market at that time. So we as most of you have likely seen, we do focus pretty heavily in the permanent crop space in California. As Gretchen spoke to earlier, over 400 commodities are grown in the state and are almost exclusive to the state. So if you're investing in most permanent crops or want to get exposure, it's hard to find opportunities outside of California for some of these crop types. So we are not solely focused on permanent crops, however. We do manage a number of row crop farms currently, as you saw with one of the properties in our fund. And the approach there, those are typically lower returning. I'd say between 2 to call it 4% net on a cash distribution basis. However, with the lease nature, they do tend to be lower risk. So it is ultimately dependent on where we are finding quality opportunities and what would be the best fit for an individual investor for their investment goals. So we have time for just a few more here. One question, will this deck be available for download on FarmTogether.com? Yes, we will make the presentation as well as a recording of this webinar available later on today. Let's see here. I get just a few more in. It's a question here on the typical time to maturity for the citrus trees at Great Valley and the yield ramp up. So for citrus, we typically model yields beginning in the 4th year and ramping to maturity in year 6 or 7, dependent on the variety and our analysis of the subject property itself. Hence why the current plantings of the property, the 2019 plantings and the 2021 plantings, that's why we believe that Great Valley will reach peak production closer to 2029. The yields will continue to mature, once we hit 2024 through 2027. Any other questions here? I guess one more question that we can fit in on Great Valley. How does the farm productivity compare with other grapefruit producers in California and the US? How is this considered in the model if natural resources like water availability get worse in the future? So our production expectations for this property are aligned with regional blocks based on the rootstock, region, and farming practices. The water basin itself was approved by Sigma and isn't projected to lack any water from the district. Additionally, we believe the well, does provide more than sufficient water to irrigate the block. Gretchen, did you have any additional last comments on that one?
No, I think that's a really good way to kind of sum it up. So basically, because this property has survived, I mean, it can be managed completely on surface water alone. The wells are kind of an extra assurance. So we won't have reached any sort of pumping allocation that may be imposed in the future.
Great, thank you. Let's see if we have any last questions here. We are at time. So I think we will wrap it up here for today. I want to thank you all for attending. And if we did not get to your question, we will be reaching out via email. If you do want to send us an email with any additional questions that come up after this webinar, please feel free to reach out to us at investments@farmtogether.com. Thank you again, everyone, for your time, and have a great rest of your day.